Alrighty. Almost 5:30, so I am here. We'll get started soon. Hopefully everyone so far who's listening is doing well. Staying safe. Getting all the school stuff they need to do done. Maybe finding some silver lining in the pass-fail system for UH now. Those of you in harder classes. I'll probably wait till about 5:35 to actually start going into the content. Let more people show up. Although, if for whatever reason you can't stay throughout the whole stream, I do have the video that I'll post. I'll cut out the part where I was gone for half an hour. So it'll be from about 5 minutes ago, well, not 5 minutes ago, about 2 minutes ago, through to the end of the stream, YouTube. So if there's any part you particularly like, you can always go back and review it later. We've actually been up for the past couple of days in the markets. Not that I think that's going to be a long-term trend, but we're going to discuss why for long-term investing that doesn't much matter. How did I? Also, I do own a cat. It's desperately trying to get in the same room as me. So if you hear what sounds like a high-pitched scream, I guess, it's at the door. And also, I'm still, because I can't go anywhere else to get a different one, using the microphone that for whatever reason turns off after like 15 or so minutes. So if I just abruptly stop talking, I'll be back. It takes about 10-15 seconds to turn back on. That's really about it. So might as well swap on over to our risk disclosure here. Excuse me. Same thing that we've always gone over, but I'm going to continue to go over it. So everything that we do here tonight is for educational purposes. None of this is a recommendation or endorsement of a particular investment or investment strategy. Past performance does not indicate or guarantee future success, and discussion of returns are all hypothetical. Everything we discuss here today as it concerns to the market and other things are going to be hypothetical, which may not include the impact of commissions, fees, or other expenses. Returns on all of your investments will vary and involve risks, including the loss of principal. I will get in a little bit, well, I say get into, I'll talk a little bit about options as a type of hedging strategy, but it's important that all investors know that options are certainly not suited for all investors, and that you should be much more aware. But anyway, options are not suitable for all investors, and you should be aware of the risks carried when trading options, and you should carefully read the document characteristics and risks of standardized options before engaging in any sort of options trading. So attendance past this point signifies that you're cool with all of that. And if at any point anyone has any questions, please feel free to ask me either in the Twitch chat, which is where I will respond the fastest, just because it pops up for me right away. I'm checking GroupMe right now to make sure I didn't miss anything there, but you can also DM me on GroupMe if you don't have a Twitch account, which I know a lot of people don't, so that's fine. Moving on. So there are three things I want to accomplish today. One of which is the thing we're going to do lastly, is going to be looking at the portfolio we started building last Tuesday. And we're going to incorporate some of the other concepts that we're going to talk about now, which is going to be dollar cost averaging and then hedging. Both of these are very vital into a portfolio dollar cost averaging is something that you don't have to do if it doesn't fit your investment objectives. However, for smaller accounts and for individuals with a consistent income and expenses, dollar cost averaging is a great way to mitigate some short-term risks, as well as get you in the market anytime, no matter what the climate is. So right now, I know there's a lot of discussion about the market not having hit the bottom, or having hit the bottom and is now going to springboard up back to its previous levels. So there's a lot of back and forth in this matter, and it's important that we know as investors, no one knows the answer, right? No one is the investing prophet that can predict these things with 100% certainty. Now, it is important to also know that when this is all said and done, there will be individuals in the money management or investment management field who said, this is going to happen. And it does. It will happen. The same way that if you flip a coin and I say it's going to land on heads, and it might land on heads. Or if you flip a 12-sided die and I say it's going to land on a 7 and it lands on a 7, it's chance. There can be some legwork involved. There can be some predictive guessing. But really, we don't know what the future holds. We don't know what's going to happen with this virus. We just don't know these unknowable things. So dollar cost averaging, as we're going to go into again, is something that will allow you to invest consistently over a period of time, and then take advantage of the price fluctuations to kind of help mitigate, again, that short-term risk. Now, dollar cost averaging, by and large, is going to be a long time horizon strategy. You're investing for the long term if you're using dollar cost averaging. And I don't want to say recommendation, but what I would do for myself, understanding myself, if I had a small account, wanted to get investing and see that the market's down this much, dollar cost averaging is something that I can do right now. Well, I guess tomorrow morning, when the market's open, to get myself and my money into the market and then continue investing from there. Now, it won't matter if the market goes up or down. We do obviously want it to go up when we use a dollar cost averaging strategy. However, the very nature of the dollar cost averaging strategy lets us know that, hey, we have some leeway here and we wind up protecting ourselves a little bit. So let's get more into that. So, as it says right here, the practice of dividing the investment of an equity up into multiple smaller investments of an equal amounts, spaced out over regular intervals. So what this simply means, and I'm going to use a year, for example. Let's say I have in my bank account right now, for easy numbers, $1,200. So I have $1,200 sitting in my bank account right now. Now, what I could do is tomorrow morning at market open, I can see a S&P 500 ETF, and I can say, okay, I'm going to put my $1,200 into that, which, to be fair, over the long term, 10 plus years, I think that's a great idea. I think you'd wind up making good money doing that. However, in order to mitigate short-term risk, we're going to go ahead and engage in that dollar cost averaging monthly. Meaning I'm going to take my original investment, what I have now, which is that $1,200, and I'm going to divide it up into equal $100 groups, and I'm going to put $100 into this ETF every single month on the same day, regardless of what's going on in the market. I don't care. Again, this is how you use this tool is what you use to build savings and wealth over a long period of time, and is a way to neutralize that short-term volatility in a broader equity market. So again, if you have some extra money sitting around, you're wanting to maybe get into the market a little bit right now, it is down. I do think by and large it's going to be a good time to buy if your time horizon is long. Obviously, there's some economic factors. The virus has not run its course. The Fed currently is doing things that we've never done before. We're definitely entering uncharted territory. But I certainly think that the strength of the U.S. financial system will endure over the long term. So, with that being said, if your investment horizon is long term, I don't think it really matters what you're doing so long as at some point you're investing in the market. If you are a short or intermediate term investor, that's a little bit more tricky. Obviously, the market may continue to go down. This might be a little bit. Some people call it a dead cat bounce, which means the saying goes, you can drop a cat from a window, a dead cat from a window, and it'll still at least bounce once. So we might be seeing something like that here. But again, I or no one else is a prophet of the future. It may be the end of this bear market. Personally, I don't think so. But even that said, I think no matter what, investing in the market at any point is a good idea so long as you're investing in a well-diversified index fund, specifically maybe one tracking the S&P 500. So, but there's a lot of other stuff you can do as well. So we're going to talk more about kind of the broader market, though. I won't get into trading too many individual securities until later. So moving on, let's go ahead and see what does dollar cost averaging look like. So this is over a 10-year period, or excuse me, 10 periods. We can just say it's over months. So 10 months here, and we have $50 contributions over 10 months. Now, on this left column here, let's see if y'all, yeah, you can see my mouse. We have this S&P 500 index fund right here. So basically what we've been talking about. Now, it looks like right here we have it at $10 per share. And then down here on month 2, it's $10.50. So we made a 50 cents per share profit on that first investment. And then we invested another $50. And we can see right here, our investment contribution never changes. It's always $50. And as we'll get into, the shares bought does change because we have this $50 at $10 a share is 5 shares. However, the price of the shares went up. Therefore, we bought less shares this time. We bought that 4.76 shares. And then month 3, it looks like here it goes up another 25 cents. So we even bought less shares then. And then month 4, it went up even more. So we have $1 profit from our initial investment to month 4, so when we buy put our $50 in, we're now buying 4.55 shares. But I don't know, something happened. Maybe there's a new virus that came out, right? Month 5 here went down to 10.25. So we bought more shares than we did in month 4, but not as much as we did in month 1. And then month 6 right here, when the economic news, it seems like, really kind of hit, we still put our $50 in, but it was at $9.95 a share. So we actually got more shares than we did on the first month we invested in, which was that 5.03. Not too much more, but some more nonetheless. And we can see a slow and gradual recovery right here over a longer period of time, ending at month 10, which is going to be that 11.25 share price. So again, we see these stock fluctuations right here, the share price fluctuation right here, but it does not matter. We don't care. We invest our $50 every single month, and it does vary the amount of shares that we buy. Some water here. Does anyone have any questions so far? I'm going to look at Group A. Oh, drop my phone. Okay. Dividend yield. How do you think the virus is going to affect dividend yield in the long term? So, when we talk about dividend yields, it depends on the individual companies. Let me make sure. I'm going to reread the dividend yield. So it depends on the individual companies, right? So companies that have a ton of cash may not be nearly as affected by all of this information, all of this kind of turmoil, because they'll be able to continue to pay their workers, be able to keep their plants and their factories open, even with a significantly decreased revenue stream. Now, if we look at other companies, maybe companies within this consumer discretionary sector, like airline travel, stuff like that, we might notice that, hey, they have significantly less revenue. So one of the options to keep their doors open and to keep their factories or their manufacturing facilities or wherever they need service centers running is they'll slash that dividend payout. Excuse me. So when they slash these dividend payouts, obviously the guaranteed, if you will, return for a period of time on that investment is going to go down. You won't make as much. Let's say an average dividend yield of 2% for large cap U.S. equities goes down to 1.5. So that means in order to compete with other forms of investment, these kind of opportunity costs, if you will, you'll need to make up that 0.5% somehow else, whether that be in just general stock price appreciation, or if it might be in something like, well, I guess you just have to wait for the dividend to come back, assuming they don't go under, and then increase it in the future. So it's going to have, it's going to have a negative effect if companies lower their dividend payouts, because there are only really two ways to make money off stocks, right? Dividend payouts and then the appreciation of the share price, in the standard sense, right? Not looking at like derivatives or anything. But so if dividends go down, obviously you're losing this kind of path of income, and a very consistent income, right? Dividends are more consistent than the broader market, at least the share price fluctuations. A stock share price may plummet, but the dividend yield may still go up year over year. But if these companies are experiencing huge drops in revenue, then that might be a much larger problem. So moving back to this just before I switch off this slide, again, we have our total shares owned right here. So we started with 5, right? We bought our 4.76 right here. So now we have just under 10. So almost an average of around 5, maybe 4.6 or something shares per cycle here, per period. So at the end of these 10 months, we have 47.71 shares with our total value of this $536.79, which is a profit and loss, so profit of that $36.79. Now, what's important here to know is that you're distributing when the market moves, you're bringing down the average price of your shares. So you're bringing it closer to the current level, which is good because that means the price of the security doesn't have to move as far for you to break even or make a profit if it goes down enough. So it looks like here, and we can see on these this bottom row here, we have the dollar cost average. So it looks like the average share price that we actually purchased the shares at was $10.48, which is 48 cents more than our initial contribution, but less than the 11.25 at the end of period 10. So anyway, dollar cost averaging, if anyone has any questions. Where do you think the bottom is? If I knew that, I won't speculate. If I knew that, I'd make a lot of money if I was right? We don't know. There's a lot of factors that go into kind of deciding where the bottom is. The only reason that share prices for stocks go up or down, let's say up, is because there were more buyers than sellers. That's it. That's the only reason. Now, obviously, there are reasons behind those reasons why. Why are people buying? Why are people selling? And it comes down to this investor sentiment. We see these people, these retail investors, kind of seeing the actions of the Fed right now, printing, just injecting trillions of dollars right into the economy as a way to kind of prop up the stock market, lowering interest rates down to zero, in an effort to make money easily accessible to investors and as well into banks who want to give out loans and small businesses, stuff like that. So we kind of see this as retail investors. It's very positive, right? Oh, we think this is great. But a lot of people really aren't taking too much of a look at how far productivity is going down within our economy. So while I think that the recent uptrend that we've had over the past week or so is great, and I'm glad that some people are finding relief. Personally, I do not think it's over. I think we're going to see the kind of broader reaching economic impact over the next couple of months. And from there, we can kind of see how the virus, if the virus runs its course in a month, and then the people who have lost their jobs can start to come back to work, and we can start being productive again, seeing that economic growth, then this may be a much shorter recession. And it's not a recession yet, right? A recession is 2 years, or 2 years, depression. 2 quarters of negative economic growth. We haven't even seen one of those yet. But it is very likely that we'll enter recession, but this might be a very short recession. Likewise, unemployment may continue to reach numbers that it has never touched before. Productivity can continue to spiral downward, and we might be in a recession for many years. I don't know where the bottom is, and I think people will speculate and try to guess where the bottom is, and I think at the end of the day, a few of them will be right, and they're going to make a ton of money. But for the vast majority of people that are speculating, they're going to lose probably everything, or at least everything that they had bet where they are finding the bottom is. Which is why I opt to kind of preach investing in for the long term and in kind of mutual funds or exchange traded funds, these ETFs, specifically the S&P 500 ETFs, although you could break that down into the mid cap or the Russell 2000, or just any other broad diversified funds, I think is the way to go right now if you have a longer time horizon. I don't think that this most recent thing was the bottom, just because we haven't really seen all of the substantial impacts of what's happened to our economy, because no one's working. We're all kind of in this state of suspended animation. So I also find it hard to believe that this was the bottom. But what you're doing is people are trying to make it a self-fulfilling prophecy, right? So many people lost hundreds of thousands of billions of dollars, right, in the overall markets through this thing. And any glimmer of hope, surely folks are going to cling on to and just be like, yeah, that was it, we're good to go now. And that makes me a little afraid, because people will buy into that a little bit more. It'll prop the markets up a little bit more, and then once we see how, hey, maybe really bad these things are, it'll all come crashing down. And because more people overextended themselves thinking this was the bottom, they might wind up being much worse off, and therefore making the economy much worse off than it would have been if people would have just let it kind of run its course without false optimism. But getting into that, we can talk a little bit about hedging, and that's protecting yourself in the short term. Now, hedging is something that, if you're a really long-term investor, you may even in and of itself find it unnecessary, because time is essentially your hedge. But for those of you seeking maybe a shorter to intermediate term play, hedges can be very important. And I don't want to say life-saving, but very comforting to have in the case of economic disaster, which is something we're kind of seeing right now. So hedging is a type of risk management strategy that is supposed to offset losses in investments. Now, it's important to note that it's not there to eliminate them. It's just to kind of cushion the blow. But paying for this protection is exactly like how it sounds. You're paying for protection, meaning that overall it will reduce your potential profits should your portfolio and should your strategy actually work in your favor. And this usually involves derivatives like options and futures, but not always. And I will talk briefly to options, but I will mostly talk about the not always part, which is hedging with stocks. So hedging is a way that's saying, hey, I have this portfolio right here. 95% of it is in stocks, 5% of it's in cash. Um, I think the market is bullish. I think the market is going to continue to go up. This is true for the majority of time. Obviously, maybe not so much right now. But long term, I have my long term investments here in my portfolio of about 80%, and then I have my short term investments of about 10%. Regardless, I want that hedge on there. I want to kind of try to protect myself from some of that downside of 5%. So 5% of my portfolio is there in case the market goes down. That 5%'s whole purpose is to make me money if the market goes down. Now, if the market does go down, I still have this other 90% of my portfolio losing money. So it's not something that's going to, again, eliminate all of my losses or do anything to prevent losses. What it's going to do, again, is just cushion that blow. So for instance, when we talk about being able to hedge in a portfolio, so you may build out your portfolio, and this is one thing I'll buy in the portfolio we have set up for the small account within Thinkorswim, the paper trading account, is we'll actually spend about 5% of that portfolio into a hedge, and just to see how it behaves. So I do have a few examples of S&P 500 ETF, inverse S&P 500 ETF tickers here. So what an inverse S&P 500 is, ETF is exactly how it sounds. The S&P goes down, this particular fund will make money. It makes money on the downfall of the S&P 500. So people who, for whatever reason, were invested in this heavily prior to that kind of market crash month that we've had have probably made a substantial amount. Likewise, if the market goes down and I was in this type of portfolio, I would wind up making a little bit money, a lot of money on that 5% of my portfolio, but losing a lot on the other 90%, right? And on the inverse of that, if the market were to have continued going up, I also expect that my hedge, my inverse S&P 500 here in this instance, will lose money. And that's fine. That's its job. I always want my hedges within my personal portfolio to lose money. That means my broader portfolio at large is not, or at the very least, nothing horrible is happening, which is good. So again, if for whatever reason you want to include an inverse S&P 500 ETF into your portfolio, I do have a few examples here on the screen of tickers. It's important you always all do your own research, look at the expense ratios and what management fees are, stuff like that, before you buy any type of ETF. But these are just a few examples to kind of see how one is structured. Basically, all of them just follow the ETF, but inverse it, right? So it's just S&P makes $1, this loses $1, and vice versa. You can find triple leveraged ETFs, which is S&P makes $1, this loses $3, or vice versa. So kind of know your own risk tolerance there. I'm going to check GroupMe real quick for any questions. Okay. Some water. And then we'll look at our portfolio within the one that we started building last Tuesday and kind of see how it performed. Hoping my academic advisor has emailed me back. But anyway. All right. So this is our portfolio as we left it on Tuesday. So you can see here that we bought our 10 shares of the S&P 500 ETF, which is by far our largest position. We bought a share of Costco, of Netflix, a couple of this MDY right here, which is a mid-cap fund, and then this SCHA, which is a small cap fund. I actually think this is Yeah, small cap fund. So we had some good market news over the past week or so, meaning that we have made money, about 1.5% over a week, which is not bad, right? Again, the whole point of this portfolio is to kind of think to the long term. Personally, I'm a little surprised that we made money last week, but that's still great. Um, Something that I'm glad we did. And we can kind of see the individual performance of things right here. The PL, profit loss open, and profit loss day, these numbers are all almost identical. Because I bought these shares at the market after the market closed last Tuesday, I had to manually adjust them within this paper trading account the day after, so it might be a little bit different, but for the most part, it's the same. So yeah, we can see right here, profit to loss since open was that 1.5, or excuse me, $152.26 from our $10,000 starting portfolio. So not too bad for a week, right? But we're scared the market's going to continue doing weird, scary things. So let's go ahead and add our hedge in there. And let's pick a symbol here. Does anyone, I'll give someone a second if they want to type in something that they want me to look at as a hedge. Otherwise, I was probably just going to do this top one right here, RVRS. Check group me, and I'll do it. Okay. So we'll look at the chart first. RVRS. Just wait, ETF. This is over a year. It looks weird though. I lied. I'm gonna do SPDN. You can see right here, this is a comparison line with the S&P 500, so they kind of play off each other. They always go away at the same time, and then they cross down here when all this nonsense started happening. But we're kind of approaching a middle right here, but I think it'll continue to go up. So we want to make this 5% of our portfolio, right? That's our target amount. So we're going to go to trade, buy. I'm going to switch over to the dollar sign right here because 5% of our portfolio is just going to be that $500, right? Nothing too big. So we'll buy as much as we can for $500. Do limits. Yep. And we will do GTC, good till canceled. Inverse ETF, yes, and confirm. Perfect. So we can see that we have now as a working order 17 total shares of this inverse ETF, constituting 5% of our portfolio as a hedge against the downside. So obviously it won't fill because the market's closed, but it's something that we have in the works. And we will leave that to do that. Hopefully we can see how it behaved come next Tuesday. Yeah, perfect. So yeah, it has the buy order right there to kind of supplement our portfolio. Now, last time when we got off the live stream, we were looking at companies that we might think will make money off of this economic news, right? Make money off of the fact that people are kind of stuck in their homes, having to contend with, I guess, entertaining themselves, not being able to go out, stuff like that. Now, I think we talked about Costco, we talked about Costco, we talked about Netflix, and we talked about 3M. as we looked at those three stocks, we found that we like Netflix and we like Costco. Excuse me, but we don't like 3M because 3M is so exposed in other areas that'll probably be losing a bunch of revenue right now, considering this economic slowdown. So, does anyone have or want to share any stocks or companies that they think might perform extremely well based off of what's going on in the broader market? And I'll give y'all a second to think and then type out something. I am going to look briefly. What am I going to analyze? I want to see if they updated this yet for consumer price index. It's something we talked about on the first live stream. I just wanted to see if they changed the cost of air travel, airline fares. If it's updated yet. No, we'll see for, well, I guess March. Yeah, March is not over yet, but we can see that decline in February. I'd be interested to see how far it goes down into March. What is American? Is it just AA? No, hold on. I thought that was a question. What is American Airlines? What is their symbol, man? American Airlines. That didn't help me. It was AAL. I was right. All right. So I just wanted to see how the airlines were doing. There's been a lot of discussion about buying the airlines because they've taken such a hard fall down to that low of $10, currently trading at just 12, a little above 12. Airlines is not something I would speculate on at this moment, but if they recover, surely there will be a lot of upside. So if you're someone who has a very high risk tolerance, that might be something you're interested in. Also, Ford has been an interesting topic of discussion recently, with their stock price falling below $4 at one point, coming to just below $5 now. So some people think, wow, Ford isn't going anywhere, right? They weren't the ones that got bailed out last recession. They should be fine, and that they're an incredibly cheap buy in this moment. Now, there's a lot of economic news surrounding Ford. Go ahead and take a look at that, actually. Look at fundamentals. Ford. It's really just this decline in a lot of their numbers here, which is interesting. Net profit margin, wow. Return on equity's been pretty consistently down. Negative revenue, net income. So they're struggling. I believe they just slashed some of their models a couple years ago. Some of those, cars that they had been manufacturing for a long time. Those models they didn't care for, they just got rid of them. So anyway, someone had asked me about Ford, and I just remembered, so I wanted to take a look at that. Scary numbers. Looking just very briefly here, although let's look at one last thing. Yeah, the price to earnings ratio is very, very high for some reason. If you're interested in looking into Ford, I would look at their 10K more to figure out where all of their money is going and why their revenue is so down. even at below $5 a share. So anyway, anyone have any particular company we want to analyze? I will look again at GroupMe. Okay. Well, if no one has any questions, I was hoping to do, last time we had some interest in like 3M and stuff like that, if we want to take a look at those types of things. So with that being said, I will take a look at some more of the economic data and we can maybe get a better grasp on what's going on with employment. Let's see here. Farm. So this particular gadget within Thinkorswim, TD Ameritrade's platform, allows us to look at a lot of the federal reports that come out. Just looking for the simple non-farm payroll. There it is. With number of jobs and such. Format with thousands. Doesn't look like it's been updated yet, so we'll be curious to see the decline as we approach February and March. See what else we can take a look at. Interest rates. Come on. Federal funds rate. Yeah, it doesn't look like this has been updated from that 1.5-ish range, which is interesting that they've gone down to 0. So we'll just have to wait a little bit longer to see how that data has been impacted here. Well, so what we've done today, we've just kind of seen where our portfolio's taken us. We've seen that it has made money on this potentially temporary bounce, right? But we're unsure as if what's going to happen in the market, right? Because we're not clairvoyant. We don't know. So we went ahead and added a 5% of our total portfolio hedge, which was just an inverse ETF, inverse S&P 500 ETF, in an effort to kind of support us in case the market does take kind of a large downturn. Now, we also understand that even though we have this hedge, this 5% position, if the market does take a downturn, the majority of our portfolio is long the market is bullish, right? So we will lose money overall, but we will lose less now than we would have had we not had the hedge. Likewise, if the market continues to rise, continues to be bullish, our 5% hedge will lose us money. But since the vast majority of our portfolio is still bullish, we will make money overall, just less money than if we would have not had the hedge. But we're kind of paying that price for some protection of our downside. Overall, if we look at our broader portfolio, we still can discern that it is very bullish still, with this IVV right here constituting about, I believe it was 25% of our total portfolio at the time of purchase, with these smaller, more riskier elements constituting, I think it was 10 and then 5% respectively. with Costco and Netflix constituting, well, Netflix was almost 4%. Costco was a little less than 3% of our portfolio. And then we still have a decent amount of cash, which we wanted to keep 5% of our portfolio in cash regardless. So we still have some room to make some more investments, and we will do that next week. I hope that some people have ideas on stocks that they want to look at that we might be able to consider investing in for the next RNT. And then lastly, before we wrap up, I just want to quickly review dollar cost averaging. I'll go back to the PowerPoint for that. All right, let's do this. So again, dollar cost averaging is a method of investing into the stock market while protecting yourself from short-term volatility, allowing yourself to put money in, the same amount of money at equal increments throughout a period of time, bringing the average share price of your investment closer to whatever the current share price is when you invest. So if the stock market goes down, or the fund that you're looking at or investing in, or even if the individual stock that you're looking at goes down, and you use dollar cost averaging, the average purchase price per share will continue to decline as you buy more shares on your regular intervals, until at which point it goes back up, and at which point it'll start increasing your average share price, kind of keeping that figure as close to the current share price as possible, protecting you from that downside risk as well. And that's really about it. I'll wait around for a little bit longer if anyone has any more questions. I know this one was a little bit shorter, but I thrive on questions, so if y'all have questions, please ask. That's where I get the majority of what I talk about, actually. If not, I'll go ahead and wrap it up here. Thank you all so much for tuning in. I will cut up this video to cut out the 30 minutes of me not doing anything from 5 to 5:30, and then post that to YouTube for anyone who wants to rewatch anything, or for those of you who had missed the original airing date. So without any other delay, thank y'all so much. I look forward to seeing you all again next week, and then we can go ahead and see how our portfolio is performed and add a few more positions. You all stay safe. Thank you.